Joy Dubai. Joy.
Thank you. Good morning, everyone. I think the fact that we're all present here today illustrates the need to include developing country concerns in the development of BEPS proposals. In the past, the OECD have refused to recognize the race to the bottom, terming it the race to the average, or what my colleague has said, the race to the middle. I think we need to start having the conversation about the race to the bottom and what international tax competition has done for developing countries in particular. We have identified two main objectives that should come out from these proposals. So simplification, effectiveness, and certainty. And as we've looked at this particular objective, we identified that the tax on base eroding payments falls short, and I'll speak to this a little more shortly. With the income inclusion rules, to the extent that it relies on the effective tax rate test, sorry, I don't have the, sorry. Thank you, sorry about that. There we go. When we talk about the effective tax rate test, there's significant complexities that could arise. And I think an OECD working paper by Hanapi has set out the wide range of potential approaches and parameters of identifying a test that could arise. And this could probably bring up the same complexities as the arm's length principle methodologies. Now, the biggest and the second objective for me and for us within developing countries should be making anti-base erosion proposals work for financing for development. We have already identified that there's significant revenue required to achieve the Sustainable Development Goals. And one of those priorities should be placed up within these proposals. We need to talk about the tax on base eroding payments and the fact that it requires it's highly reliant on administrative capacity. It's highly reliant on significant cooperation and full transparency, and I believe full transparency is probably very unrealistic for administrative cooperation. It will require equal capacity. Again, that's highly unrealistic from where we stand. Finally, as I've begun my presentation, it's addressing the global race to the bottom. We need to respond to the base erosion impact that has resulted for a lot of developing countries. And I keep repeating developing countries because we need a little more representation in this room as well. With regards to the policy rationale, we're speaking more to income inclusion rule because we do believe that the tax on base eroding payments is rather complex to implement. So we're perhaps a little bit more supportive of the income inclusion rule. We would ask that we focus more on defining the tax base. An effective tax rate test is quite difficult and it may be an intermediate step. We'll have to spend a lot more time discussing how to develop that when we should be talking about the factors, employees, sales, perhaps even capital. Deciding on tax rates should be left to countries with perhaps a minimum or a floor that would identify whether or not the country falls within a certain threshold. The question is, do we have consensus? Is consensus realistic? Again, the final thing for me is we need to talk about the corporate group and how we're defining a corporate group. We need to ensure we have a very robust definition of a corporate group. And one of our suggestions is actually looking into upwards and downwards, direct and indirect, the shareholding and control by all members of the group. This would allow us to actually include limited risk distributors and or commissionaire arrangements. Finally, it is desirable to have a minimum tax. It will stop the race to the bottom. We must accept that there's a tendency for developing countries to rely more on corporate income taxes. We want to push away from relying too much on indirect taxes, which have some risks for progressivity. Yes, regarding the economic and behavioral implications, we tried to base them on each proposal. So we tried to talk about income inclusion rule from the behavioral perspective. Now, I've already talked about us needing to identify factors for the tax base. There is a risk around capital, and that risk is actually around the way in which capital can be manipulated or the value of capital. So we need very strong accountancy standards. I think Professor Saul has suggested something around looking at each industry and developing a standard based on each industry. For the economic behavior implications, we need factors that will allow us to raise sufficient revenue for developing countries for the achievement of the Sustainable Development Goals. I've already highlighted why capital might be problematic and why we will specifically need to address the challenges of capital within our proposals. Transparency is key. And a robust transparency system will be key for this to work. But the current country-by-country reporting rules need to be made public. We also need to remove the restriction for adjusting profits. It's highly important for developing countries that may not have access to some of the information to be able to make their adjustments based on what is included in the country-by-country reports. Last and not least, I think my most controversial statement today will be, is the OECD the appropriate forum for us to be doing this? Do we have true coordination in this forum? We need a proper global tax body that can include all concerns and represent all concerns. Thank you.